I know there was this back and forth about whether the 10 and 2 years inverted. My take is it did not. Rick, we came awfully close to it. Does that count?
Yeah, you know what? I don't know that it counts, and I don't think in the grand scheme of things it's going to make much difference. It will invert. The question is what does it mean? And I would state it as follows. If you have a cold, you sneeze. But if you sneeze, you don't necessarily have a cold. Whether you look at the 90-91 recession, the 2001, the 08-09, or the 2020, in every case, 2s to 10s inverted prior. But also 3 months to 10s inverted prior as well. And my argument would be all yield curves inverting potentially can lead to recession. But since 3 months to 10s is so steep and 2s to 10s isn't, I would just stick probably with the lowest common denominator, because in every instance of recent recessions, 3 months to 10s did invert and a recession did occur.
All right, that's a fair point. Steve, you want to explain it a little bit about why this is a signal of a recession, what it's telling us?
It tells you that the Fed is raising rates, and the markets believe down the road the Fed will likely go too far and have to cut rates, and going too far means it's in a recession. I actually, if you know, I guess different strokes for different folks here. I like the 3-month, 2-year spread, and the reason is because it's in the window you're trying to forecast. I get the idea that the 210 has this very good record, although there's a question about its record in 2019, in my opinion, because the inference in 2019 is that it somehow foresaw the COVID outbreak, which doesn't make a whole lot of sense. That said, I like the 2-month, 3-year. That shows you it is really spiking right now, kind of along the lines of what Rick was talking about. It's just a nearer term spread, and it's within the zone that you're trying to forecast. You want to know what's going to happen in the next couple of years. Not entirely clear to me why the 10-year would be giving you that kind of information.
Hey, Anthony, we have seen a significant move in rates. It's something that everybody's watching, paying attention to. You think that the move we've seen to this point is an accurate reflection of what's happening in the economy and what's expected to come from the Fed?
Yeah, we do think that this is an accurate reflection. We think that rates and the Fed were particularly behind the curve when you compare it to the economic realities on the ground. We have a hot labor market, inflation running at 40-year highs. So we thought that the yield environment that was pervasive in 2021 was too low. And now you're seeing investors and the Fed itself catch up to economic reality. The bottom line is that you need significant amount of monetary policy tightening if you're going to corral rising inflationary pressures here. And we think that right now, given that the market is pricing for 8.22, we think that's a more realistic scenario of what's going on.
So, Anthony, what would you tell people to do right now when it comes to anything in the bond market? What do you like? What do you not like?
Yeah, so I think the prevailing message we would tell investors is to sell into strength. You've seen a rally in risk in the last few weeks here, and we're using the opportunity to go up in quality in our credit portfolios. More particularly, we're rotating out of single B names and into triple B names and into single A names here. We're rotating into defensive sectors like pharmaceuticals and utilities that should be able to withstand a slowdown in the economy or withstand increased volatility from the tightening cycle that we are about to see. So that's some of the things that we are thinking about in our portfolios.